Ryan buys a rental property. Derek puts the same money into index funds. They both think they made the smarter choice. They're both wrong. One forgot to count the hours. The other forgot to count the zeros. When you run the real numbers over 20 years, the gap will make your stomach drop. Ryan and Derek both have $50,000 saved. Same age, same city, same starting point. Ryan uses it as a down payment on a rental house. His tenant pays $1,800 a month. On paper, that's $470 monthly profit. Ryan feels like a genius. Derek drops the same $50,000 into a total stock market index fund. Sets up $300 monthly. Never thinks about it again. His coworkers ask what he's investing in. He says index funds. They nod and change the subject. Ryan has a house and a story for dinner parties. Derek has a confirmation email. The feelings aren't close. But feelings and math are two very different things. Ryan drives past his rental on the way to work. He thinks, I own that. It feels real and smart. Meanwhile, Derek logs into his account once a quarter. The number goes up, then down, then slightly up again. There's no key in his pocket. No tenant texting him. Just a number on a screen. After year 3, Ryan's gross cash flow looked great. Then came property taxes, insurance, repairs, vacancies. Ryan manages it himself to save money. That means late night calls, weekend showings, repairs on his lunch break. His actual net cash flow over 3 years? Somewhere between $2,000 and $4,000 total. Derek's portfolio hits $76,000 by year 3. 0 phone calls. 0 emergencies. 0 hours spent. But Ryan still has leverage. His property appreciated and his equity grew to roughly $60,000. That's the power of leverage. And it's the one advantage index fund investors simply cannot replicate. The rent check number is what everyone brags about at barbecues. Nobody talks about what comes out of it first. Vacancy. Maintenance. Capital expenditures. A roof replacement alone can cost you $10,000 overnight. If you're not budgeting for these guaranteed future costs, you're not running a business. You're running on luck. If you're watching this and building something real, subscribe. More breakdowns like this one are coming every week. By year 5, Ryan is deep in landlord reality. Third tenant. Replace the roof. Raised rent to $19.50. His actual cash-on-cash return hovers around 3 to 5%. Not the 20% he bragged about. Derek is still doing absolutely nothing. By year 7, his portfolio sits at roughly $145,000. Compounding is boring for the first 5 years. Then it becomes astonishing for the next 15. That's the trap. By year 10, both are surprisingly close in total wealth. But how they got there is completely different. Ryan spent hundreds of hours managing. He took on massive debt concentrated in one asset, one zip code. Derek diversified across thousands of companies and never lost a single night of sleep. By year 20, both land between $400,000 and $500,000 in net worth. But the journey was not equal. Stocks have real risks too. In 2008, the market dropped 37%. In March 2020, 34% in weeks. Most investors panic sell during crashes and buy back after recovery. They lock in losses at the worst possible time. Index funds give no monthly cash flow. No depreciation deductions. No leverage multiplying your initial investment. Real estate wins when cash flow math works from day one. When you treat it as a business, not a side hustle. Neither Ryan nor Derek sat down and mapped what this truly costs in dollars, time, stress, and risk. The real trap is picking either one based on a podcast clip, a headline, or something your uncle said at Thanksgiving. Next time someone says real estate always wins or stocks always win, ask them one question. Did you include everything? Because the answer that includes everything is the only answer that actually matters.